Welcome to the Deep Dive. Our mission today is to cut through the complexity of decentralized finance and trace the evolution of a protocol that is truly, well, fundamental to the entire ecosystem, Uniswap.
It really is.
And this isn't just a history lesson. What we're doing here is laying out a blueprint for understanding how core financial infrastructure gets built, how it gets iterated on, and eventually how it gets monetized in the crypto space.
And when you look at all the DeFi infrastructure out there, Uniswap really stands alone in its pioneering role. It launched way back in November 2018 as a non-custodial automated market maker, an AMM built on Ethereum.
And its genius was its simplicity, right?
Exactly. It
Right.
replaced the traditional messy order books you see in conventional finance with these simple, elegant liquidity pools. And that experiment, which is what its founder called it, is now the largest decentralized exchange on the planet. It moves trillions in value.
So our focus today is to trace that entire trajectory from the intensely personal, almost accidental genesis of its founder, Hayden Adams. I mean, this is a guy who went from a layoff to leading a multi-billion-dollar project.
It's an incredible story.
And we'll go through the monumental technical overhauls, versions 3 and 4, and then land right in the present with the recent critical economic and regulatory changes that have completely redefined what the UNI token actually represents.
We've got a huge agenda. We're going to start with that really unexpected founding ethos, then dive deep into how concentrated liquidity in V3 revolutionized capital efficiency.
And we have to spend time on V4.
Oh, absolutely. We'll analyze the visionary architecture of V4, specifically the singleton contract and the power of hooks. Then we'll get into the regulatory side, the vindication with the SEC closure, which really paved the way for the most consequential change of all, activating the protocol fee switch.
So if you stick with us, you are going to walk away from this deep dive with a really comprehensive understanding of the forces that are shaping DeFi's next decade. Okay, so let's start at the beginning, which is, I think, surprisingly human and relatable. Hayden Adams, the founder of Uniswap, he wasn't some blockchain prodigy.
Not at all. He was a mechanical engineer working at Siemens, and his entire journey kicks off with a setback. On July 6, 2017, he gets laid off.
And that's usually a low point for anyone. But the story here is the immediate intervention from his social network.
It's the defining factor. Adams recounts this low point to his friend Carl Flourish, who was already deep in the space. I mean, Carl was working on the technical architecture for Casper FFG at the Ethereum Foundation. He was an insider.
And Carl, embracing that early, almost fanatical Ethereum spirit, he doesn't offer sympathy. What was his immediate response?
It's amazing. According to Adams, Carl just declared, "Congratulations, this is the best thing that could have happened to you." It speaks volumes about that early, almost evangelical belief in Ethereum's potential. Carl basically painted mechanical engineering as a dying field and Ethereum as the absolute future. He told Adams, "Your new destiny is to write smart contracts."
And he was apparently very reassuring about the learning curve, famously telling Adams that coding was easy.
Which is, maybe not technically accurate for something as complex as smart contract development, but it was the push he needed.
So Adams took it to heart.
He really did. He spent 2 intensive months, this is August and September of 2017, just teaching himself the fundamentals. Ethereum concepts, the Solidity programming language, and JavaScript for the front end.
But he wasn't setting out to build a global financial system from day one. This was just a self-improvement project.
Exactly. The initial project idea came directly from Carl, who suggested he try to implement an automated market maker.
And this idea wasn't totally original to them.
No, it was directly inspired by posts written by Vitalik Buterin, Ethereum's co-founder. Vitalik had already sketched out the mathematical framework for how you could build a decentralized exchange without needing order books.
So Adam spends the next couple months, October and November 2017, building this proof of concept, this POC, and he found it wasn't work at all. It was genuinely captivating.
He described it as finding the most intriguing thing he had ever worked on. This is really the moment he falls completely down the rabbit hole of programmable money.
And even in that early stage, he saw the potential.
He did. He recognized the, frankly, abysmal user experience of existing decentralized exchanges at the time, like EtherDelta. Adams's simple pool-based demo just felt inherently superior in its intuitiveness, and that focus on simplification, that became the core tenet of the whole protocol.
But the reality check was pretty rough. He was unemployed for 5 months, living off a small stash of crypto he'd bought earlier. And technically, that first version, the V0 POC, was severely constrained.
Oh, the constraints were significant. First, the pool wasn't generic. It only supported a single Ether20 token pair.
Okay.
And second, and this is a massive limitation for a DEX, it could only handle a single liquidity provider. It was proof that the math worked, sure, but it was also proof that the architecture was not scalable at all for a public protocol.
Then help arrived, almost by accident.
It did. Carl Flourish used Adams's working demo as an example in a talk he gave at DEF CON 3. And an attendee, a man named Pascal Van Heck, reached out.
And that moment provided the structure and the financial runway he needed.
It was crucial. Van Heck provided Adams with a small grant to fund his next month of research. For an unemployed, self-taught engineer, that external validation, that financial support, it was priceless. It added accountability and allowed him to just focus entirely on the technical hurdles.
And by early 2018, he had solved those core smart contract issues.
He nailed two key architectural improvements. First, the exchange contracts were redesigned to support multiple LPs. They did this using internal liquidity tokens, which you can think of as like receipts that track each provider's share of the pool.
And the second one was the factory contract.
Right, the factory contract. This was the key to scalability. The factory allowed the protocol to deploy new exchange contracts for any ERC20 token paired with ETH. And that, in turn, enabled anything-to-anything swaps because you could just use ETH as the intermediary route.
This is when the project starts to feel less like an experiment and more like a real product. The technical foundation was solid, and a team started to form around the design.
Right. Adams brought in Khalil Kaportso, who was a seasoned designer from Microsoft and Google, to work on the front end. Adams was pretty honest that his initial code was untenably bad React.
I think we've all been there.
Which prompted another friend, Uciel Vilchis, who was also convinced to learn to code by Carl Flourish, to just refactor the entire front-end code base in March of 2018. It really shows you how Uniswap was a product of that early, interconnected, collaborative Ethereum community.
But the real sort of institutional validation came in Seoul at Deconomy 2018. Adams, after traveling outside North America for the first time in his life, runs into Vitalik Buterin.
The encounter is just legendary for its immediacy and its transparency. Adams introduces his project, and Vitalik's first question is whether it's open source.
Of course.
Upon confirming it was, Vitalik immediately reviewed the entire contract code right there on his phone. This wasn't some formal due diligence meeting. It was an impromptu public code review in the middle of a conference.
And Vitalik's suggestions were critical.
They were defining. First, he suggested rewriting the contracts in Viper. For our listeners who don't code, Viper is a smart contract language. It's influenced by Python, and it's specifically designed with security and auditability in mind. It intentionally limits some of the more complex features of Solidity to reduce the attack surface.
And his second suggestion?
Apply for an Ethereum Foundation grant.
Adams acted fast. He spent 2 weeks rewriting the code in Viper, which must have been a challenge because the Casper FFG contract that Carl was working on was essentially the only complex Viper reference implementation available at the time.
It was a huge undertaking. But the grant for $50,000 plus audit costs arrived in late July 2018.
So the tech is solid, the funding is there. The final piece of the puzzle was actually the social explanation.
Right. At NYC Blockchain Week in 2018, Richard Burton, the founder of Balance, helped Adams overcome his tendency to lead with the formula, X times Y equals K.
Which is the math of the AMM, but it's not very user-friendly.
Not at all. And Burton helped him realize that the biggest challenge was social, not technical. People didn't need to understand the CPMM formula. They needed to understand the utility, that they could swap tokens easily and without a custodian. The explanation needed to be framed on users' terms, emphasizing simplicity, not abstract math.
And of course, the name. Adams originally wanted to call it Unipeg,
Which is a choice. Vitalik heard the concept and, maybe unintentionally, provided the branding. He remarked that Unipeg sounded much more like a Uniswap, and it just stuck immediately.
After all that, rigorous security checks, an audit and formal verification by runtime verification, a final reentrancy attack audit by Phil Dine V0 was ready. The only hiccup, Vitalik catching that Adams had misspelled recipient as recipient about 20 times.
Which is a great little detail. But the meticulousness of the audit process, even with that amusing slip, it really underscores the commitment to security from day one. And so Uniswap V0 was deployed to the Ethereum mainnet on November 8, 2018, the very last day of DEF CON 4.
And it wasn't some big celebrity launch. How much liquidity did it actually start with?
About $30,000. across 3 different token pairs deposited by a single Brave provider. It was just enough to facilitate small swaps, but the real power was that it was permissionless, it was censorship resistant, and it was entirely utilitarian. The ethos of decentralization was successfully realized.
So those early versions, V1 and V2, they were really defined by that core constant product market maker model, the CPMM. And the simplicity of that model, the whole X times Y equals K thing, is what made it so robust, but also so capital inefficient.
Incredibly inefficient. The CPM model is mathematically elegant for sure. X and Y are the reserves of the 2 tokens in the pool, and K is the invariant, which has to remain constant. If you want to trade, say, token X for Y, you deposit X, which increases the pool's X reserve, and in exchange you get Y, which decreases the pool's Y reserve, all while maintaining that constant product K.
And the key for V1 and V2 pools is that they maintained liquidity across the full theoretical price range. We're talking from 0 to infinity. They were designed to keep both assets at roughly a 50-50 ratio in dollar terms.
Correct. And the upside was simplicity and, guaranteed liquidity no matter how extreme the price movement was. The downside, as you said, was terrible capital efficiency. Most of the capital deployed by liquidity providers, or LPs, just sat there dormant, waiting to facilitate trades at price points the assets would never realistically hit.
And the LPs were compensated with a small slice of the trading fees, like 0.3% in V2,
Yeah,
for taking on that risk.
right, for both the risk and the opportunity cost of locking up their capital.
And then V3 enters the picture. And this fundamentally changed the game with concentrated liquidity. This was the dramatic leap forward.
It was a huge innovation, really driven by the recognition that capital is much better deployed where the action actually is. V3 allowed LPs to define a custom limited price range, what they call a tick range, where their capital would be active and earning fees.
So if the price of ETH is, say, $3,500, an LP doesn't have to provide liquidity all the way down to $100.
Exactly. They can focus their capital only between, let's say, $3,000 and $4,000.
Which sounds amazing for the LPs. They can earn the same amount of fees, but with significantly less capital just because their capital is being used more frequently.
Precisely. It enables far greater capital efficiency for LPs and, this is critical, better prices for the traders because the depth of liquidity is so much greater around the current market price. V3 also introduced multiple fee tiers, 0.01%, 0.05%, and 1% to cater to different pairs and volatility levels.
So stablecoin pairs could trade with much less friction.
Right. And the liquidity position itself became an NFT. Why was that necessary?
That's a great question.
It's because, unlike V2, where all the liquidity was fungible, you could just redeem your percentage share if the pool V3 positions are unique. Each LP chooses a specific non-fungible price range and a fee tier. Therefore, their specific stake in the pool, their liquidity position, it had to be represented as a non-fungible token, an NFT. This definitely increased complexity and required active management.
And we really have to emphasize the critical trade-off here. V3 is fantastic when the price stays within your chosen range, but what happens when it moves out?
That's the major risk LPs now have to actively manage. If the token price moves outside that established custom range, the position becomes out of range. At that point, the LP's position is composed entirely of the less valuable asset. It's single-sided, and crucially, it stops earning any trading fees.
So that massive efficiency gain comes at the cost of needing to be an active manager and significantly increasing your exposure to impermanent loss, or IL.
Exactly. Impermanent loss is inherent to all AMMs, but in V3, if the price flies past your upper or lower tick, you're literally left holding a bag of the devalued asset, and you're not even being compensated with fees for it. You essentially have to manually withdraw, adjust your range, and redeposit. This shift dramatically raised the barrier to entry for casual LPs, but at the same time, it professionalized the market making on Uniswap.
And that professionalization made Uniswap a genuine competitor to the centralized exchanges, the CEXs. The data we've seen suggests a really fascinating interaction between the decentralized and centralized markets.
The analysis shows what is basically a zero-sum competition for liquidity provision. When Uniswap improves, say there's a surge in V3 efficiency, higher volume, or more transaction activity, it exerts this downward pressure on the entire market. Specifically, it lowers the liquidity provision premium that's required in centralized crypto markets.
Because if Uniswap is doing a great job providing cheap, deep liquidity, then the CEXs don't need to overpay their own market makers to bring that same depth to their order books.
That's the mechanism. And conversely, the analysis highlights the inverse relationship. When conditions on Uniswap get worse, maybe due to network congestion leading to high gas fees or a broad increase in impermanent loss pushing LPs out of range, the required compensation for liquidity provision in centralized markets rises.
So CEXs are basically compensating their liquidity providers for the deteriorated conditions of their decentralized competitors. It's a sign that the whole ecosystem, centralized and decentralized, is now deeply interlinked.
Absolutely. They're compensating based on the performance of the lowest cost, most efficient provider, which very often is Uniswap. However, as you alluded to, that massive success, particularly through V2 and V3, it created a huge problem. Scalability. Operating on the Ethereum mainnet meant high gas fees that threatened to choke off the very efficiency V3 had created.
And that's where Uniswap's success became an unprecedented accelerator for Layer 2 or L2 solutions.
The volume migrating to L2s tells the story perfectly. L2s like Arbitrum, Polygon, Optimism, Base, and Zora, they process transactions off the main Ethereum chain, which drastically reduces fees while still leveraging Ethereum's base security.
And the data is just staggering.
It is. The combined volume across L2s using Uniswap went from just about $6.5 billion in 2021 to a ninefold increase, reaching almost $55 billion in 2022.
And it just kept climbing. The cumulative volume hit nearly $119 billion in 2023 and then peaked at an unprecedented $279 billion in 2024.
That growth trajectory proves that while the Ethereum mainnet provides the security layer, the actual economic activity and user preference for cost efficiency have firmly shifted to L2s, and Uniswap is serving as the primary DEX across all of them.
So that growth confirmed the product market fit. But V3, while it was architecturally brilliant with concentrated liquidity, it still lacked the foundational flexibility needed to keep pace with rapid DeFi innovation.
You were stuck. If you wanted to add a complex new feature, you were basically out of luck. And that brings us to the visionary overhaul that is Uniswap V4.
V4 is, I think, widely considered the most ambitious technical upgrade in the protocol's history. It's not about refining the CPMM or liquidity concentration anymore. It's about rebuilding the protocol into a customizable platform. The core problem V3 faced was, as you mentioned, that lack of extensibility.
Correct. The V3 architecture really forced developers into a bind. Let's say you want dynamic fees that change based on volatility. You'd need to propose an entirely new core protocol because V3's math was immutable. V4 was designed specifically to solve this by externalizing custom logic. It introduced 4 major architectural breakthroughs that just maximize customization and gas efficiency.
Okay, let's start with feature 1, the singleton contract. This is a fundamental change in how pools are managed.
It completely reverses the old pattern. In V1, V2, and V3, the deployment model required a new factory contract for each new token pair. If you launched a new token, you had to deploy a whole new exchange contract.
Which cost gas every single time.
A lot of gas. In V4, we utilized the singleton design pattern, a single massive contract that holds and manages all the pools.
The consolidation itself sounds like a huge logistical improvement. But what are the measurable benefits?
There are 2 main ones. First, gas cost reduction. Since you're not deploying a separate contract for every new pool, you're just updating internal storage within the singleton. The deployment cost for a new pool drops by approximately 99%.
99%. That's a game changer for long-tail token projects.
It is. And the second benefit relates to trade efficiency and composability, which is vital in DeFi. The single contract boundary makes cross-pool operations seamless. Multi-hop trades, say swapping token A for ETH in one pool, then ETH for token B in a second pool, are drastically simplified. All the funds stay within the protective boundary of the singleton contract.
That structural change leads directly into the next feature, feature 2. Flash accounting. This is the engine that drives V4's gas savings. How does the singleton enable this efficiency engine?
Flash accounting is basically the genius of internal bookkeeping. In the previous versions, every single operation, a swap, adding liquidity, removing it, required an external expensive token transfer at the end of that step.
Right.
In V4, operations just update an internal ledger-like net balance, which the protocol calls a delta. The actual external token transfers using the take and settle functions only happen once, right at the very end of the entire multi-step transaction, which is enforced by an architectural lock.
So, okay, let's imagine a complex transaction. You swap A for B, then you deposit B into a lending protocol via a hook, and then you withdraw C. In V3, that would be three separate, expensive external transfers.
Right, but in V4, it's one massive internal calculation where all the state changes are tracked in memory as deltas. Only the final net effect, the tokens you needed to take from the singleton and the tokens you needed to settle back into it, triggers those external transfers. The protocol ensures solvency is maintained at the end of that lock.
And this efficiency is tied to a specific Ethereum upgrade, EIP 11153. We need to define that jargon for the listener.
Right. EIP 11153 introduced what are called transient storage opcodes. And you can think of transient storage as highly volatile memory that only exists for the duration of a single transaction and is instantly erased afterward.
In contrast to standard storage, which persists on the blockchain forever and is extremely expensive to write to.
Precisely. By leveraging transient storage, V4 can perform all this complex internal accounting, balance calculations, and intermediate state management at a fraction of the gas cost of V3. It makes these complex, multi-step operations economically viable for the first time.
And now for what I think is the most exciting innovation, feature 3, hooks. This is what transforms V4 into that customizable platform we've been talking about. So what is a hook, structurally?
A hook is simply an externally deployed smart contract. Its purpose is to allow developers to inject arbitrary custom code into the pool's execution at specific predefined moments. When a pool is created in V4, the creator has to specify a hook contract that the singleton will then call out to.
So it's like adding middleware to the core AMM function. Where in the process does this custom logic actually execute?
V4 supports 10 specific callback points. This is the when of the hook's execution. These callbacks are strategically placed throughout the life cycle of a pool operation. We have callbacks for initialization, before initialize, after initialize, liquidity management, before add liquidity, and trading operations, before swap, after swap.
So, for example, a before swap hook could check the time or the market volatility and adjust the swap fee before the transaction even executes.
Exactly. And then an after swap hook could be used to immediately execute a related action like updating an oracle or triggering a lending position adjustment.
This just opens the door to features that were previously impossible without entirely rewriting the core protocol. Let's explore some of the most compelling examples made possible by these callback points.
The ability to innovate is, it's virtually limitless. For instance, using a before swap hook, you can implement dynamic swap fees. This allows the fee to fluctuate based on market conditions. Maybe it increases during high volatility to compensate LPs for that increased impermanent loss risk.
Or it could drop during stable periods to encourage more trading volume. That's a huge improvement over the static fee model of V2 or even the fixed tiers of V3.
Another critical application is on-chain limit orders. An after-swap hook can be programmed to automatically fill limit orders. The LP can set a range, and when a trade pushes the price to a specific tick level, the hook contract executes the fill and rebalances the position, automating what was a totally manual process in V3.
And for institutional-sized trades, hooks enable things like TWAM, the time-weighted average market maker execution.
A TWAM hook just slices massive orders into tiny time-space swaps over hours or even days, executing them silently into the pool via the hook contract. This minimizes the price impact, the slippage, that a single large trade would normally cause. It makes the protocol suitable for institutional scale.
What's really fascinating is the ultimate flexibility, this idea of using custom accounting via hooks. Does this mean a developer could just entirely bypass the V3 concentrated liquidity math?
Yes. This is the ultimate architectural abstraction. Developers can program their hook to return custom deltas or net changes to the singleton. By doing this, they are effectively overriding the native concentrated liquidity model. They're using the singleton not as an AMM engine, but as an arbitrary delta resolver and as a secure settlement layer.
So, in theory, I could build a constant sum market maker or even a classic Uniswap V2 content product pool, but as a hook, and still get all the benefits of V4's gas efficiency and the singleton's composability.
That is precisely the power of it. V4 provides the secure, audited, gas-efficient infrastructure, and hooks allow anyone to plug in their own custom AMM logic. It turns Uniswap into a truly permissionless platform for AMM experimentation. It's the ultimate future-proofing move.
Finally, we should touch on feature 4, the return of native ETH support. This seems simple on the surface, but it's a massive user experience improvement.
It is. V1 had it, but it was complex to manage, so V2 removed it in favor of using WETH, or wrapped ETH. Now, thanks to the efficiency of flash accounting and the singleton structure, V4 can reintroduce native ETH pairs without worrying about liquidity fragmentation.
And the cost benefit here.
It's significant. A native ETH transfer costs about 21,000 gas. An ERC20 transfer, which WETH is, costs about 40,000 gas. Since most users start or end their transactions in native ETH, removing the need for them to wrap or unwrap their ETH saves nearly 20,000 gas per operation. It's a direct, measurable improvement in both cost and user experience, and it addresses one of Ethereum's chronic pain points.
So V4 is the technical roadmap. But to execute on that roadmap, Uniswap needed stability on the regulatory front, which had been a significant point of contention for years. And in early 2025, they finally got it.
It was a huge moment of validation for the entire decentralized application space.
Hmm.
On February 25, 2025, the SEC officially closed its multi-year investigation into Uniswap Labs with no action.
And this was after the SEC had issued a Wells notice, which is a very serious signal that enforcement action is likely. The core allegations were that Uniswap Labs was operating an unregistered securities exchange, engaging in unregistered broker activity.
Or issuing an unregistered security, the whole trifecta.
Right. And the closure provided this much-needed, if still narrow, regulatory relief. Uniswap Labs framed it as a significant victory for the broader DeFi community, and it affirmed their consistent position that their operations are in compliance with applicable laws.
And that regulatory clarity provided the confidence they needed to move forward with the most consequential internal change in the protocol's history.
Which brings us to the unification proposal, which passed governance in late 2025. And this was not just a technical tweak, it was an existential shift for the UNI token itself.
It was the long-awaited activation of the protocol fee switch, and it is absolutely one of the most consequential token economic transformations among DeFi blue chips since 2020. It was designed to fix what the market perceived as the weak token problem.
Okay, explain that disconnect. What was the core vulnerability of the UNI token before this vote?
The vulnerability was structural. The UNI token had historically functioned purely as a governance token. So token holders could vote on upgrades like V3 or V4, but they had no direct economic entitlement to the massive cash flows the protocol was generating.
So Uniswap was processing billions, often outpacing centralized exchanges in daily volume, but the value of the protocol's fees accrued solely to the liquidity providers, or in some cases, the development teams.
Exactly. The fundamental problem was that the token's market value was totally detached from the protocol's high usage and success. It relied on a kind of speculative faith in future utility rather than current cash flow.
And the unification proposal just shattered that model.
Completely. It explicitly links UNI's value to protocol usage. It shifts the economic nature of the token from governance only to a deflationary value accrual asset. The high usage that Uniswap commands now directly translates into demand for and, critically, a reduction of the UNI token supply. This sets a precedent for how every large DeFi protocol is now expected to structure its economics.
So let's get into the mechanics of unification. It was a comprehensive plan that addressed governance, existing fee structures, and future revenue streams all at once.
The proposal had 4 interlocking components. First, the most immediate effect, activating protocol fees and UNI burns. This means that a portion of the trading fees that were previously collected entirely by LPs on V2 and V3 pools on Ethereum mainnet are now diverted.
So a pool fee might shift from, say, 0.30% entirely to LPs to 0.25% for LPs and a 0.05% protocol fee that's directed toward this new UNI burn mechanism.
Precisely. LPs take a small reduction in their fees, but the entire ecosystem, including the token holders, benefits from the value capture.
And what was the second component?
Second, and this was a massive immediate statement of intent, was the retroactive treasury burn. Governance voted to conduct a one-off burn of 100 million UNI from the treasury, effectively backfilling years of missed fee capture. It immediately signaled a huge commitment to a tighter supply schedule.
Third, they integrated future scaling revenue through the Unichain revenue integration.
Right. Unichain being an L2 or an application-specific chain, it generates sequencer fees. After you deduct the base L1 data costs and you share a 15% portion with the underlying Optimism platform, those net sequencer fees are directed into the same UNI burn mechanism.
And the final piece was about organizational alignment.
Yes, organizational alignment. This restructured the funding model. It folded many of the foundation's functions into Uniswap Labs, set a disciplined 20 million UNI per year growth budget for the Labs team, and effectively reduced the Labs take rate on their interface and APIs to 0.
So it focuses the development team entirely on protocol adoption, ensuring that incentives are perfectly aligned with the token holders who benefit from the burn.
Exactly. The entire system hinges on the integrity and automation of the burn mechanism itself, which uses a pipes model built around specialized smart contracts.
How does that value flow programmatically?
The model is designed to be immutable and non-discretionary. Trades generate fees, and the protocol's portion of those fees flows into a single vault contract on each supported chain, which is named the token jar. The token jar is designed solely to accumulate value. That's its only job.
And what's the mechanism that ensures this value is actually converted into deflationary pressure on the token?
The only way that value can programmatically leave the token jar is if it's used to acquire and burn UNI, and it does this via the specialized fire pit smart contract. This two-contract pipes model ensures that all protocol revenue, whether it's from V3 fees or Unichain sequencer revenue, is strictly directed toward reducing the UNI supply. It programmatically destroys the token, turning it into a deflationary asset tied directly to economic activity.
Okay, let's analyze the immediate financial impact based on that early post-unification data from January 2026. The initial revenues were strong.
They were. Over the first 12 days, the cumulative protocol level fees reached roughly 800,000 USD. If you annualize that initial run rate, it translates to approximately $26 to $27 million in protocol revenue captured per year.
And the immediate supply reduction was dramatic, mostly because of that retroactive burn.
Yes. The total UNI burned immediately shot up to about 100.7 million UNI, which represented 10.1% of the original 1 billion UNI supply. Now, while the 100 million from the Treasury burn accounts for the vast majority of that, the ongoing programmatic burns, the actual run rate from current fee capture, are tracking at a solid annualized rate of roughly 4 to 5 million UNI per year. This demonstrates the economic engine is actively reducing supply.
And this is where we need to apply the critical lens, because with the fee switch on, you and I can actually be valued on fundamentals. At a market valuation of $5.4 billion in early 2026, compared to that implied $26 million annualized revenue run rate. The numbers are kind of shocking.
They absolutely demand scrutiny. That ratio gives us a revenue multiple of roughly 207 times.
210.
To put that into perspective, mature, high-growth tech companies in traditional markets often trade at multiples between, say, 15 and 40. Even the most aggressive, early-stage tech growth stocks rarely sustain a multiple over 100 unless they are showing just exponential, sustained user growth.
So the market is viewing UNI not as a decentralized exchange currently operating at its peak, but as a pure, high-growth tech asset. What is that high multiple pricing in?
It's pricing in immense future growth and significant fee expansion. First, it implies the market expects Uniswap to capture dramatically higher fees, maybe by expanding the percentage captured in existing pools, or by increasing the number of covered pools, or through the aggressive adoption of V4.
And second, it must embed massive success for Unichain and its sequencer revenue, which is still a pretty untested concept at scale.
It does. If that $5.4 billion valuation is to be justified, the $26 million in annualized revenue needs to become something like 200 or 300 million, and very quickly.
The pressure is really on the developers now to rapidly deploy V4's customized hooks, which are explicitly designed to increase that revenue surface area. For example, a hook that implements a sophisticated fee-generating volatility oracle could drastically increase revenue streams that were impossible under V3.
That's the key. Conversely, the immediate risk is competitive decay. If a rival DEX emerges with a more capital-efficient V4-style architecture, or if a high-profile hook implementation fails, that revenue stream could be undermined.
And then there's a regulatory risk.
Absolutely. If the regulatory clarity from the SEC closure doesn't extend to the rest of the world, or if global regulators decide to specifically target these new deflationary burn-driven token models, the legal risk could tank that speculative multiple instantly.
So this entire evolution, from the technical complexity of V4 to the economic shift of the fee switch, it's all tied together by the necessity of justifying that incredibly high market expectation. The architecture needed to evolve to support the valuation.
That is the perfect summary. The technical innovation, the hooks, the singleton, flash accounting, they are all foundational tools designed to facilitate the complex revenue-generating strategies required to compress that astronomical 207x multiple over time. The economic model is now explicitly linked to the product's engineering roadmap.
This has been a monumental deep dive into the evolution of a cornerstone protocol. We started with the accidental genesis. A mechanical engineer, Hayden Adams, laid off from Siemens, being pushed into code by a friend, Carl Florsch. And that initial ethos of pure permissionless utility led to V0 in 2018.
And that initial experiment rapidly evolved into a multi-billion-dollar entity. We traced the critical leap in capital efficiency with V3's concentrated liquidity, and then the architectural foresight of V4, leveraging the singleton contract and flash accounting to reduce gas costs, and EIP 1153 transient storage to enable efficient, complex internal bookkeeping.
The ultimate innovation, V4's hooks, turns the protocol into a platform. It allows external developers to inject custom logic like dynamic fees and complex market maker curves, which drastically increases the protocol's potential revenue streams.
And at the same time, the institutional validation provided by the SEC investigation closure in February 2025 gave the necessary certainty to enact the most consequential internal change, the unification proposal. This structurally tied the UNI token's value to the protocol's high usage via a programmatic deflationary burn mechanism.
And now V4's technical architecture is directly focused on increasing that revenue surface area required to meet the massive growth implied by the token's valuation.
The sheer numbers really speak to Uniswap's product market fit. I mean, cumulative volume has passed into the multi-trillion-dollar range. This stability, coupled with the new fee-linked model, is setting a profound precedent for how the entire DeFi sector must now value protocol tokens.
We're moving away from speculation based on governance potential toward tangible deflationary economics driven by usage.
Right. The integration of value capture with token supply reduction fundamentally changes the relationship between a user and the token they hold. But while the fee switch activates value capture, that $5.4 billion valuation requires immense sustained fee expansion and growth. And this leads to the ultimate test for the future.
The structural shift in UNI's economics is now explicit. Protocol usage leads directly to value accrual and token scarcity. And this raises an important question for you to consider as you digest this deep dive. Given that DeFi protocols now clearly link token value to protocol economic activity via these deflationary burn mechanisms, how will global financial regulators interpret and classify these explicit revenue-driven token models moving forward?
Are they still merely utility or governance tokens? Or has the fee switch turned them into something entirely new in the eyes of the law?
That is the critical question that will define the regulatory future of decentralized finance. Thank you for joining us for this deep dive into Uniswap. We'll see you next time.